going to dive right into the S&P 500, or if you trade the Nasdaq, this is going to be for you as well, right? So if you're in bearish market conditions, how can you take advantage of such a bloodbath? Well, let's go over it, right? So you don't want to neglect how you trade the markets themselves, right? So we always start with our market structure. So notice how we have a structural high, structural low. This is the breaker structure, right? So from here, I would mark my structure something like this. I would start off with basic market structure, get an overall feel for the market. We had a pullback over here, and then we had our final all-time high over here. This was our breaker structure, right? So the first thing to understand is you must be dealing with the basics, right? So we've had a shift in the market structure resting over here in this region, right? So price is now broken to the downside over here, right? So price has given us sorry for that. Price is giving us a break over here. And now from here, when I mark out my structure, right, I was explaining to a few of my students, when I mark out my structure, I want to see sharp moves down, sharp moves up, sharp moves down, sharp moves up, sharp move down. So you're looking for these sharp areas in price over here. So when we look at the actual price action, this for me is still a structural range because the fair value gap is all the way up here. Now, with that being said, we also had another sharp move down, right? So we are now inside of a dealing range. So what do I mean by a dealing range? So once you have your structure established, right, we're looking at a dealing range. So a dealing range is the most recent swing high and the most recent swing low. So this is the most recent swing low. This is the most recent swing high. And then, of course, we have the break. So our dealing range consists of this high and low over here. So when we zoom into the regular price action, what we are looking at now, when I use the Fibonacci tool, I simply project the Fibonacci tool in this way. So I project it from the swing high down to the swing low, right? Swing high down to the swing low. And now from here, we're in an interesting area where if we just mark this up again, we've had a clear break of structure to the downside. So price has broken structure over here. It is from here we now go down to the 4-hour time frame. So on the 4-hour time frame, we have a similar scenario, right? So I always mark out 4-hour structure because I find it more accurate than the daily structure. So the 4-hour structure, just to speed things up, we had a structural low, we had a structural high, and now from here we had a break all the way down here. The break wasn't over here. This is not a strong break, right? So the break was this move over here. So now we need to look at our most recent dealing range. So the dealing range is again the most recent swing high down to the most recent swing low. Now from here, when we understand the dealing range theory, what we need to understand is we're looking for fair value gaps in the premium or the discount. So this is, of course, that 50% area. Now, when we look carefully into these candles and we understand what's going on, we can see the following. We can see prices left an inefficiency or a fair value gap just over here. We have a tiny fair value gap here and we have some fair value gaps. Prices come and filled all of these fair value gaps. So one question you need to ask yourself is when you're forming a daily or just a higher time frame bias, you want to just understand a few things, right? So if we just kind of take this to the side, what you need to understand is the markets will do something like this, right? The markets will give us a dealing range to work with. Now we have a dealing range high up here and we have a dealing range low down here. This here will give us our premium and discount arrays. Now, when we come into a premium, if price mitigates a higher time frame fair value gap in the premium, so something like this, we can see prices, of course, left a fair value gap. So the fair value gap is going to be somewhere around here. I'm going to label that in blue, right? So this is going to be the fair value gap, and this is, of course, going to be our area of supply or simply a POI. So when price comes into this area and we respect this area, this gives us an indication to take sells down to at least the equilibrium, right? At least down to the equilibrium. If not, ideally, you want to be looking for fair value gaps in the discount below the 50% area. Now, when we go back to the regular candlestick chart, right? When we go back to our charts, what we can see is price has given us these fair value gaps over here, which price has come into. Notice how we're above the 50% level. So we're in a premium, which means we should be looking for sells. Now from here, when we go down to the 15-minute time frame, so the 15-minute time frame is where I start using what we call the weekly PO3, right? Or the weekly power of 3, right? And the weekly power of 3 is very, very simple. So I just want traders to understand exactly how I do this, right? So on the weekly time frame, what you're basically looking for is you want to just change this. This is PO3 by 2 degrees, and you're looking at this weekly candle projection over here. So the greatest tip I want traders to take away from this is that when you're trading the weekly power of 3, this is the weekly opening price just over here. You want to be looking for sells, and we're going to be breaking down a scalping sell you could have taken over here. And you want to be looking for buys below the weekly opening. So we can see after the FOMC, we've significantly extended above the weekly opening price. This is the reason why sells became valid. Of course, we tapped into a higher time frame POI, and now from here we're above the weekly opening price, which means that sells are more likely to work out, right? Because you want to be selling above the weekly opening price. Now from here, let's go to the 4-hour PO3, which is my favorite time frame to use, right? Favorite PO3 time frame to use. So what we're looking for now is my entry model, which is something I've discussed on many videos before. So we're just going to break it down. When price leaves a fair value gap, right, we always look for 15-minute fair value gaps. And this is the key. So we mark out a zone or an area which leaves a 15-minute fair value gap. Now, I'm going to explain the difference between a POI and a fair value gap. So pay attention to this very closely, right? So the POI is different to the fair value gap because the POI will be the candle or the range just before the fair value gap. So this is the fair value gap that I'm labeling in blue, right? That's the blue fair value gap over there. We can all see that. Now, the reason I mark my POIs like this, I've had lots of questions on this, is because price needs to come into this zone and fill the entire fair value gap, right? So let's just break that down so people can understand. Price needs to come into this area to fill the entire fair value gap. The best trades come when the fair value gap is filled, not partially filled or a little bit filled. You want to wait for the fair value gap to be filled. So this is the best way you can filter out losses, is by using the candle or the range before the POI. Now from here on the 5-minute time frame, we simply wait for price to come into this area. So if you're struggling with your psychology, FOMO, fear, this is probably the best way to eliminate that, right? So if we just play price on a little bit more, this is where things become interesting. So we've now moved on to the PM session, right? So the PM session is, of course, 2 p.m. Eastern. This line I'm drawing over here is the 2 p.m. Eastern candle opening, right? So 2 p.m. EST. Now, so the entry model is very easy to understand, right? So once you have a key level, let's just draw this out over here. So once you have price coming into it, let's say a key level like this, you want to wait for price to open up. This can be either the 10 a.m. or the 2 p.m. candle. And you basically want to be looking for sells above this candle opening price, right? That is the best way to trade any market, right? You want to be using the PO3 with key levels, right? So now that price has come into this area where we're looking for a CISD, right? Change in state of delivery. But how do you know that price is going to change the state of delivery? So one thing I often say to traders is do not trade at the candle opening. Do not trade at the candle opening. Always look for price to give a second mitigation into the zone and trade sells above the candle opening, right? So this is where the footprint charts become basically necessary, right? This is the best way to form a CISD, right? If you're looking for order flow and you want to trade properly, right? So we're going to be reading the candles, right? We're reading inside of the candles, right? So let's look at the first mitigation and study what was going on. We have a red candle over here, but what's interesting is most of the volume was situated at aggressive buyers, right? Important to understand, a red candle with aggressive buyers. That's very possible. So when we dive into the price action over here, what we're seeing is we're seeing 151 for 458. So I'm not reading every number. I'm only reading certain highlighted areas the ATAS platform gives me at key levels. So I'm not looking to read every single candle. Also coming into the zone, right? Just below the zone, 65 for 274. So we had aggressive buyers driving price into the zone, right? Again, aggressive buyers over here. So we have a lot of aggressive buyers trying to drive price up. Again, when we look here at the top, right? Right at the top of the rejection, how do you know a key level is going to hold, right? How do you know that the price here is going to hold and it's not going to break this level? Well, it's quite simple. You just read the order flow. So what's going on where I've highlighted, right? This is what's going on. So when you come into this area, this is what we're reading. We're reading the rejection over here. So we're seeing 35 for 267. So there's way more aggressive buyers than there are aggressive sellers. And this is where it's important to understand. Even here, we see 5 for 9, 197. So there's significantly more ask volume than bid volume. But despite that, we see the market giving us multiple rejections and then ultimately breaking to the downside. So when you're looking for scalps, you want to ask yourself, where are the buyers being trapped in this case? Here we see buyers being trapped, buyers being absorbed, which means they were not able to break above the level. That's exactly what was going on in this region. So let's bring this over to one side. This is exactly what was going on the candlestick chart. So on the candlestick chart, we can see here, we saw a number of aggressive buyers that were failing in this region. And this is what gives us the indication to take shorts at the level. So notice how when we take a short position, we're above the 2 p.m. Eastern, we're entering off this level, and we have a stop loss near this particular area. Now, with that being said, you simply want to be targeting a 1 to 2 risk to reward down to the next fair value gap, right? So the next 5-minute fair value gap is just over here. But the way you validate your trades is simply by reading the order flow itself. As you can see here, price does in fact come into our area, just hitting our overall TP over here. Bit of a choppy market, but nevertheless, you need to be using order flow to confirm all of your trades, right? So let's summarize this one more time. So when price comes into a key level, so let's say this is a key level of supply meaning a bearish POI, somewhere we want to be selling from. Now, when we come into this area, you want to see price coming in. Aggressive buyers are coming into this area. These aggressive buyers stall and the price breaks. So you either can enter here or you can wait for a retest to enter over here. Now, of course, you want to be targeting the next fair value gap and you want to be below, let's say, the 10 a.m. Eastern price, right? So if you're, above the 10 a.m. Eastern price, if you can sell above the 10 a.m. Eastern and you wait for buyers to fail, aggressive buyers want to drive price higher, but they fail, right? And the only way we can know that, truthfully, is by reading the POI or the fair value gaps, right? So we're seeing aggressive buyers. Those aggressive buyers were not rewarded. And that's ultimately the reason why you can take shorts to the downside, right? So if you like this video, give it a like, give it a thumbs up, and I look forward to seeing all of you in the next one.